In the gilded halls of global finance, a silent drama is unfolding. Gold, the age-old symbol of wealth and security, is locked in a tense standoff with a single, formidable number, $4,000. For weeks, the precious metal has flirted with this price, a ceiling it just can't seem to break. It's a moment of profound suspense for investors worldwide, a high-stakes game where billions are on the line. Why, with global uncertainty at a fever pitch, is gold hesitating? What invisible force is holding back the tide? And more importantly, when will the dam finally break? This isn't just a story about numbers on a screen. It's an investigation into the deep currents of fear, strategy, and power that shape our economic world. To understand what's happening, we need to pull back the curtain on the forces at play, from the hushed corridors of central banks to the frantic energy of the trading floors. The global economic landscape is fraught with tension, a perfect storm that should, by all accounts, send investors flocking to the safety of gold. Historically, when uncertainty reigns, gold shines brightest. It's the ultimate safe haven asset, a tangible store of value when currencies and stocks falter. Yet despite this textbook environment, gold's ascent has been dramatically halted. The market has entered a dramatic phase of consolidation. Analysts who have been watching this play out with bated breath now project that the price of gold will continue to hover around the critical USD 4,000 per ounce mark for the next few weeks. However, the consensus among them is clear. The probability of a powerful upward surge far outweighs the risk of a significant downturn. The current pause isn't a sign of defeat, but rather the coiling of a spring gathering energy for its next decisive move. The question on everyone's mind is not if, but when. The primary culprit behind this frustrating stall is an information vacuum. Emanating directly from Washington, D.C., a protracted U.S. government shutdown has thrown a wrench into the gears of the global financial machine. The regular flow of critical economic data reports on retail sales, job creation, and inflation has ceased. Without these vital statistics, investors are effectively flying blind. This cloud of uncertainty prevents them from making the bold, decisive moves needed to push gold past its current resistance. The 4,000 United States dollars per ounce level has become more than just a number. It's a powerful psychological barrier. Traders and institutional investors see it as a line in the sand, a technical and mental fortress that's proving incredibly difficult to breach. Even as the long-term fundamentals supporting gold, such as relentless central bank buying and simmering geopolitical risks, remain firmly in place, the short-term hesitation persists. Investors are poised, waiting for a clear signal, but the signal has been silenced by political gridlock. This period of consolidation, however, should not be misinterpreted as weakness. On the contrary, it is a testament to gold's incredible resilience. In the face of short-term volatility and a profound lack of directional clarity, the fact that gold is holding its ground near historic highs is a powerful statement. Analysts are quick to point out the solid fundamental bedrock supporting the market. The current price action is seen as a healthy pause, allowing the market to build a stronger base before its next leg up. The data blackout in the United States has created an unprecedented situation. Investors who rely on a steady stream of economic inputs to gauge the health of the world's largest economy and predict the Federal Reserve's next move are now operating in the dark. Without fresh data to fuel their models and justify new positions, gold has been struggling to gain the decisive momentum needed for a breakout. This has led many to turn to the technical charts for clues. The Relative Strength Index (RSI), a key momentum indicator, is currently hovering around the 50 mark, signaling a neutral stance neither overbought nor oversold. More compellingly, the 50-day and 200-day moving averages are converging, drawing closer together each day. This pattern is a classic precursor to a major market move. Technicians are watching this convergence with keen interest, as a breakout above 4,000 United States dollars could trigger a golden cross, a highly bullish signal where the shorter-term average crosses above the longer-term one, often heralding the start of a major new uptrend. Looking beyond the immediate noise, the long-term case for gold remains overwhelmingly bullish. Three powerful drivers are aligning to propel the precious metal higher in the coming months. First, Central banks around the world are continuing their unprecedented gold buying spree. Nations are diversifying their reserves away from the US dollar, seeking the stability and neutrality that only gold can offer. This sustained institutional demand provides a formidable floor for the market. Second, the specter of persistent inflation has not been banished. Despite central bankers' efforts, underlying price pressures remain, eroding the real value of fiat currencies and making gold an attractive hedge. Finally, there is a growing risk of a significant correction in equity markets. After a long bull run, stocks appear overvalued to many, and a flight to safety could trigger a massive capital shift from equities into gold. For investors looking to navigate this complex environment, the strategy recommended by many experts is one of patient accumulation. The current range between $3,900 and $4,000 per ounce is seen as an attractive entry zone. Financial advisors suggest a portfolio allocation of approximately 5% to 10% to gold, which can be achieved through various instruments like gold-backed ETFs or futures contracts, depending on an investor's risk tolerance. It is also crucial to keep a close watch on key market indicators. The direction of the US dollar index will be a critical factor, as a weaker dollar typically provides a tailwind for gold. Equally important will be any signals regarding the Federal Reserve's future interest rate policy. Any hint of a pause or a pivot towards rate cuts could be the catalyst that finally unleashes the bull. The stage is set, the players are in position, and the world is watching. The great gold breakout of 2025 is not a matter of if, but when. And for those who are prepared, the rewards could be historic.